The market has been very volatile, and as you can see, this has been driven by the developments that's evolving very quickly with the COVID-19 situation, which started in China in late January and has spread across Asia, and we are dealing with that situation as we speak. So that has been driving the volatility that we have seen in the market in recent months. We have been doing the same. We have been focusing on our knittings and continue to focus on quality of companies. We believe that quality companies will be more resilient during volatility, more resilient during times like this. And what we mean by quality companies are companies with strong balance sheet that will allow them to ride through the rising credit risk better, that will allow market leaders that are quality in their own right to be able to grow their market share when growth recovers, and companies with strong governance will allow them to have longer-term sustainable growth over the long run. So we have been taking advantage, looking very closely at the growth risks within the horizon, and discerningly take this as a buying opportunity to add to the quality companies that have been sold off because of the indiscriminate selling we have seen in the market. I'll separate the outlook into two parts. First is the short-term outlook and the longer-term outlook. The short-term outlook is volatile, and we have low visibility given the evolving situation that we have been seeing in the market. And therefore, as a result, we see increasing risks and we see increasing challenges as key economies across Asia and globally continue to contain the risk of COVID-19 and continue to navigate the risk of what this actually means to the impact of businesses. So growth risk on the short term is real and it is challenging. Good companies will be able to navigate it through, but it will be a challenge as well. That said, it is not all doom and gloom. This is pretty much reflected in the pricing environment, where we start to see Asian equities being more attractively priced after a big sell-off in recent months. So if you look at valuation today, Asian equities are trading at below 1 time standard deviation of its long-term average on a price-to-book basis. We know earnings will come down in the short term, but we think the longer term growth opportunities remains very much intact. So if we move to the longer term outlook, we think it remains the same, very structurally positive. We think that Asian economies and Asian companies are very well positioned to capture on the growth of consumer, capture on the growth of rising consumption and wealth across Asia. The key difference today is that it is a better price, it is more attractively valued. So for long-term investors like us, if we are patient and we take this opportunity to selectively add to the quality of our companies, we think we'll emerge much better over the long run.